Good afternoon, everyone, and welcome. Thank you for joining us for this virtual discussion on the post-election financial markets. I am Jean Kabongo, Campus Dean for the Mumma College of Business at the University of Sarasota, South Florida, Sarasota-Manatee campus. I will moderate this event along with Sean Ahern, Director of Marketing and Communications at the University of South Florida, Sarasota-Manatee campus. This virtual discussion is sponsored by Cumberland Advisors, the University of South Florida, Sarasota-Manatee campus, and the Global Interdependence Center, or GIC. What is the impact of the United States presidential election on financial markets? Specifically, how would the political and economic landscape look like as we move forward? How about interest rates? How would be the impact on domestic and international equity markets? Now, to answer these interesting questions, we put together a panel. Each of the panelists has extensive experience in the area of investment, fixed income, monetary economy, portfolio management, equity strategy, global economy, quantitative strategies, and you name it. Now, the diversity of expertise should allow the panelists to consider the major questions from different points of view, which will strengthen the discussion on the future of financial markets post-US presidential election. You are welcome to use the chat to ask your questions during the presentation. Again, Sean and I will moderate the event. We will sort your questions and assign them to the panelists at the end of all the presentations. We will do our best to make sure that your questions will be answered by our panelists. This event is recorded, and our IT team will be emailing you, all the participants, a link to the event. And now it's my pleasure to introduce the Regional Chancellor of the University of South Florida, Sarasota-Manatee campus, Dr. Karen Holbrook, for her opening remarks. Dr. Holbrook?
Thank you very much, Dean Kabongo. It's also my pleasure to welcome all of you to the University of South Florida, Sarasota-Manatee campus. We are the smallest of the three campuses that have undergone consolidation recently into one University of South Florida. We have only about 2,000 students, but our students have access to every single one of the academic programs and all of the resources at all three of the campuses. So this has been a great change for our campus as well as for all of those. University of South Florida is also designated as a preeminent university in the state of Florida. This means that we have achieved the performance metrics that are necessary to be considered preeminent by the legislature. So we're excited to be part of this major research university. It is a real privilege for me to introduce David Kotak, Chairman and Chief Investment Officer for Cumberland Advisors, based in downtown Sarasota. David's been here for over 10 years, having moved from Cumberland Advisors in New Jersey in 2009. The University of South Florida Sarasota-Manatee campus has been very fortunate to have developed a wonderful relationship with David. Let me give you a couple of examples. In 2017, David and Cumberland Advisors made a very generous donation to our campus that established the Bloomberg Lab. This is a lab like none other in the University of South Florida group of universities, in that we have 12 Bloomberg terminals with real-time financial data that is used by investors, and it provides our students with the opportunity to earn Bloomberg Market Concept certification. Cumberland currently employs 6 of our graduates, all with Bloomberg certification. David, Cumberland Advisors, and the Global Interdependence Center have also partnered with our campus to host several very special events. We've had 4 financial literacy conferences, special conferences on Cuba and on the Caribbean and on climate change. David was also the keynote speaker at our 9/11 celebration a year ago when we were able to get together outside on the campus, as David was in the World Trade Center when the first plane struck. Just last week, the University of South Florida announced another wonderful gift from David and his partner, Christine Schlesinger, that will support the development and delivery of a new continuing education training program for the University of South Florida College of Nursing. This is going to help our nurses stay safe while treating patients during the COVID-19 pandemic. It is a 4-series education series called Frontline Nursing During COVID-19, A New Paradigm. This is going to be offered virtually to nurses locally, statewide, and nationally. And we are so pleased to have a relationship with David, with Cumberland Advisors, and the Global Interdependent Center. And I think today is an example of one of the great programs that they have all put together. So with that, please welcome David Kotak.
Let me just say, Cumberland has had a developing relationship with the university, as you described, and we continue to do so. We are delighted to be active in Sarasota and growing in Sarasota and continue to establish our headquarters and develop here. We have the largest head count ever in the history of the firm. And most of those folks are here, citizens in Sarasota, households in Sarasota. And of course, we're delighted to have 6 USF graduates now on as part of our staff. I know we have limited time this morning, so let me do this. Let me get to a few slides so I can get out of the way and colleagues of mine can get into the real meat and substance of the presentation. I think there's a cover slide. It's gone, and I think you now should be seeing a slide of a building. That building is the headquarters of the People's Bank of China. And I start there because of dramatic events which have occurred with this reference. The first and largest bond market in the world, you're going to hear a lot about bonds from some colleagues, John and Patty. The first and largest bond market in the world is the United States. What's not well known is the second largest domestic bond market in the world is China. And China is also involved, very recent announced, 15 countries, it's the largest among them, in a trade relationship. You'll hear about it later in this presentation. And you need to know that the United States is not a part of that trade relationship because of the last several years where we have had the practice of isolationism and protectionism. So I start with a picture of a building, but what goes on in that building is the center of regulation of the second largest economy in the world, emerging as a force. We just saw the force activated when an initial public offering, what would have been the largest initial public offering in the world. It's associated with Alibaba and it's called Ant. And what we learned was it was pulled by a regulatory decision 2 days before it was settled. The size of that offering was larger than the value of JP Morgan Chase, the largest private financial institution in the United States. Let me get to the next slide. The next slide shows the categories of people in the United States. You can see the silent generation. I'm one of those. There are some on this call, and you see 5 categories. I want to go to the category of millennials. Why millennials? Because they are the force in a population that instills the growth economically, and they are the developing force in a population that accumulates wealth and therefore drives investments. In the United States, we have about 80 million millennials. Of the 80 million, about 10 million deal with some form of opioid or other process. Of the remaining 70 million, about 35 million, or about half, are very seriously involved in education, higher education. They see some of them attend USF. About half of the 70 million. The other 35 million do not. They have a different lifestyle, different criteria, and with COVID in their difficulties, that has become doubly so. Let's contrast that with China. There are 400 million millennials in China. They are accumulating wealth, knowledge, they thirst for education, they study hard, and they are very much involved in their country. That's a contrast between the United States, the largest economy in the world, and China, the second largest economy in the world. That is the background setting for global financial markets, in bonds, in stocks in the United States and abroad, worldwide. You'll hear about them, and we'll get to the last slide, please. The last slide is from Oxford Economics, and it's a graphic depiction of where we were before COVID. We were on a trajectory to be a $20 trillion economy in size. Then we had a shock. You can see the shock on the slide. We went in 6 weeks to a level that was not seen since the Great Depression of the 1930s. And we are now on a recovery or trajectory. And we've got an extension or forecast of the trajectory as it will evolve in the future. One thing we need to rethink about in terms of financial markets, economics, and anything that has to do with simple math. Suppose you start at 100 and you go down 30%. You're at 70. Then you come back 30%. Where are you? You're not back at the 100. You're at 91. We went down 30%. We are coming up the other side of the V, but when we get back to the top of the V, our economic framework will not have recovered to where we started. That may take several years. Financial markets are looking ahead, not at the present. They're looking for that recovery, and it's the drive of that recovery and how it evolves, plus how it interfaces with the rest of the world, that will impact the US financial markets, stock markets, and bond markets, and our relationships worldwide. Let me stop here and pass the time on so my colleagues can have more of it, and the Q&A will be at the end. And again, Karen, we thank you for the opportunity to participate with USF. Thank you.
Thank you, Mr. Chairman, for the overview of the political and economic landscape and the implications for the elections. The contrast you draw between the US and China and how the financial markets are looking to come. Our next session will focus on bond markets and credit, and specifically interest rates, the Fed, and Congress. It's my pleasure to introduce our panelists. Eddie Sanchez, PhD, financial instructor in the nomenclature business at the University of South Florida, Sarasota-Manatee campus. John Musso, CFA, President, Chief Executive Officer, and Director of Fixed Income at Cumberland Advisors. Bob Eisenberg, PhD, Vice Chairman and Chief Monetary Economist at Cumberland Advisors. And Patricia Healy, CFA, Senior Vice President of Research and Portfolio Management at Cumberland Advisors. Panelists, the floor is yours.
First slide shows you the 10-year U.S. Treasury bond. We use the 10-year U.S. Treasury bond in lots of our work at Cumberland because it's the most liquid bond market in the world. It is the easiest proxy for interest rates in general. So many things are set off of it, from mortgages, loans, etc. And so it is very, very important to our work. And when you take a look at this, it basically takes you back from the beginning of October to the end of last week. And if you look at what happened really starting around the 15th of October or so, you can see yields start to rise on the 10-year government bond. And what was that? That was the bond market starting to discount a blue wave. In other words, a Democratic White House, Democratic House of Representatives, which we already had, and a Democratic Senate. And as yields moved higher, part of that was based on the fact that this blue wave would be able to pass legislation, do spending easier, etc., and inflationary expectations would rise with that. That indeed what happened. And what you saw was an amazing amount of Treasury shorts built into the market. That means traders starting to short the Treasury market, believing yields would continue to go higher. That lasted until a little after the second presidential debate, not the town hall, but really the last presidential debate when they were both on stage. And the perception out of that was, hey, this could be a closer election than people think. Treasury shorts started to unwind their positions. Yields started to come down. Treasury shorts got caught a little bit and had to buy back their contracts. And you can see yields declined really till you got to a few days before the election. Then yields started to climb again. And that was because a lot of the polls really, even though the perception was the election would be close, the actual polls hadn't really narrowed that much, and particularly not in the swing states. And as we found out, those are right. So we saw yields continue to rise. And then you got the election, and what did you get? You didn't get a blue wave. You got basically a mixed wave. You got what also appears as a Democratic White House. You got Republican gains in the House of Representatives, and you got what looks like a Republican Senate. We will not know for sure until the two Georgia runoffs, but our best guess is that you end up with slight Republican control. That is mixed government. That is gridlock to an extent. Bond yields took their cue from that, and you saw yields come down significantly because the idea was legislation would get passed, but it would be slowly, it would be grinding, and basically the kind of inflationary expectations that had been built into the blue wave had been removed. And that was good until a week ago Monday, when you saw this upward jump in yields, and we know what that was. That was Pfizer announcing their vaccine, and as top of that, Moderna announcing their vaccine this week. And we have seen yields jump up and down, but there's clearly an upward movement in the rates, and this is really saying that the economy is now in handoff position between where we were with lots of Federal Reserve help, etc., and it's going to be moving hopefully into a more normalized economy. We can go to the next slide. This is the Treasury yield curve, showing you where you were right before the election and right afterwards. And if you go back all the way to where you were at the beginning of February, the green line, you can see how much of a shift this is. So with all the machinations in the market, the Treasury curve, basically on the longer end, from essentially 15 years, 10, 30 years on out, is pretty much the same as it was pre-pandemic. Yields have gyrated around. What's really changed is you can tell short-term yields are much lower now than they were in the beginning of the year. That is the Federal Reserve dropping short-term interest rates. And the most important part of this graph is the fact that it is a positively sloped yield curve. That is a sign of an economy that is going better. It means people demand more for their bond yields going out further in maturity. That is a good sign for the economy. If we can go to the next slide. This measures bond market volatility, how much bond prices are moving up and down. And you can see the gigantic movement we saw last March. And we saw the 10-year bond yield essentially dropped from almost 2% where it was at the beginning of the year, got all the way down to 0.3. As we sit here now, it's around 0.85. We expect that to move higher, but you can tell, and this chart needs a little bit of updating, but the volatility in the bond market is significantly less. We expect that to move back up again towards more normal volatility in the bond market. And that's strictly going to be as you get this handoff, basically from a government helped economy to an economy that's going to be on its own post-vaccination. And let's go to the last slide. This is the 10-year municipal market advisors, plenty of people that provide indices on a 10-year, basically municipal bond index. And what we did is we placed it over a US Treasury yield. Most times since the Great Recession in 08, this has trended around that 100% level, that 1%. You can see the trend at the beginning of the graph. And you can see this explosion in March. And that was municipal yields, as well as every other type of yield, just going tremendously higher because of the downdraft in the market. We have spent the last few months with yields repairing themselves, yields coming down. We expect this to continue. We think the election itself was a very good outcome for municipals, and a couple of reasons for that. Number one, we talked about the fact that it looks like a bit of a gridlock in Congress. That's a good thing. Why is that a good thing? Because it probably means that the Biden administration will most likely get a tax increase, a marginal tax increase in the federal tax rate. That helps municipal bonds, bigger demand for municipal bonds. They probably do not get a cap on municipal interest, which they had talked about when Biden was vice president because of the split government. In other words, capping the benefit of municipal bonds at 28%. That probably does not happen. That's a good thing for munis. And the last thing is that you are most likely looking at another stimulus package coming, and that will help municipalities. And clearly, the vaccine news will help lots of municipalities, and particularly the more pandemically challenged issuers that really depend on economic activity. Think about colleges with dorms, think about convention centers, transit systems, airports, things like that. So we expect this trend to continue. Thanks very much, and I'm going to pass it along to my colleague, Bob Eisenbeis, who will talk about the Fed.
John, thank you very much. It's a pleasure to be able to participate in this conference, and hopefully we'll have some very interesting and challenging questions when we finish. Recent Fed actions after the election have had significant and will have significant implications, both for interest rates as well as markets going forward. Interestingly enough, the FOMC's November meeting ended the day after the election. So we pretty much know how the Fed is going to approach policy, really in this post-election environment. The key here, I think, is, and the key word is policy accommodation. And it has several important but extremely different dimensions. So I want to run through them a little bit so that we get some feel for what exactly the Fed has done and what it might do. First of all, on March 16th of this year, as the pandemic began to really manifest itself, the Fed cut the target rate for its federal funds rate to range between 0 and 0.25%. And it indicated at the November meeting, which I just mentioned, that which was of course after the election, that it intended to keep interest rates low, short interest rates low, for really an extended period of time. So how long is that? That's the question. The Fed says that that will be until it judges that employment has reached what it regards to be the maximum full employment possible for the economy, and until inflation, average inflation, is above 2% and trending upward. Now, to be sure, the Fed has been silent on what it views as the maximum full employment and how much inflation needs to be above the average before it might need to consider acting again. Presumably, this is one of these situations, they'll know it when they see it. But importantly, the Fed has and will continue to do more than just keep interest rates low, particularly when it comes to concern about the smooth functioning of financial markets, which it has been mindful of for some period of time, and the need to stimulate the economy. Now, for example, it's been engaging in what I term to be a mini quantitative easing program since about March of this year. And it has pledged to continue buying about $120 billion in government and mortgage-backed securities per month, 40 billion in MBS and 80 billion in Treasury securities. The first chart that we look here shows the pattern of what's happened to the Fed's balance sheet as a result of these purchases. You'll note that in February, the Fed's balance sheet was 4.2 trillion. That contrasts with what it was before the financial crisis that we had in 2006, which was about 860 billion or thereabouts. So now we were at 4.2 trillion in February of this year. By June, because of these asset purchase programs, its balance sheet was now over 7 trillion. And if we project out that it will continue on its buying track, which it said it would, it will hit 8.6 trillion by the end of 2021. Should those purchases continue? And we have no reason to believe at this point that they will not. This raises some questions about the future in terms of how will it normalize its balance sheet? How will it get on track to essentially get back to what a normal balance sheet is and should be, and what the sort of path will look like? Those are all questions that they have not focused on at this point in time, but will be ones that will be significant as far as policy, probably in 2024 and 25 going on. So they, because of the support that they provided, have put in place a set of policy issues that they're going to have to deal with in the future, which will be extremely challenging. And of course, they can't really sell securities because if they do so, they carry them on their books at par. So they would incur capital losses in most instances, particularly if interest rates move up, and assuredly they will once the economy recovers. And that means they would have to sell those securities at capital losses, and the Fed only has 40 billion of capital at this point in time. So we don't want to be in a position where it looks like the central bank is technically and economically insolvent. So that's just a problem for the future, but it's on the horizon. Now, another dimension, if we can go to the next chart, please, is the fact that the Fed has also instituted a series of emergency lending and liquidity programs, which I've diagrammed here on this chart. The most significant is the central bank liquidity swaps program. That's the dark line you see. That peaked at 449 billion the last week of June 2020. But now the program is virtually unused. You'll notice it's way down, and a number of the lending programs have really been unchanged and are virtually relatively quite small compared to the markets that they've been involved with. The Fed also instituted a policy in March to support the primary dealers in the repo market. But in fact, there's been no demand for temporary funding of securities in that market by the primary dealers since about July or so. So all of these recent trends seem to indicate, when you look at these programs and the fact that they really haven't been taken down much, indicate that markets seem to be functioning pretty well now during the pandemic. So these programs seem to have been working. Even though the programs are small at this point, some have argued that their mere existence functions as a de facto safety net. I'd like to draw the analogy here between a trapeze artist and the net below the trapeze artist. Once the artist knows that they can work confidently, and if they make a mistake, the consequences won't be very great. They're less likely to make a mistake. And I think that's sort of the way to think about the fact that these programs have been put in place. The Fed is there, they're listening, and they will respond. So where does this leave us? I'd like to conclude by just sort of suggesting that the bottom line is that rates are going to be low. They're going to be low for an extended period of time. An extended period of time clearly is going to be dependent upon what happens as far as the unwinding of the virus contagion that we're facing. John already mentioned the good news that we've had about vaccines, and reading the most recent press accounts suggests that there may be even more vaccines on the horizon coming forward, which means that production and distribution, the more producers we have with effective vaccines, the easier it will be to get things back into people's hands, and the quicker we'll get back into a more normal environment. The Fed, if you read its statements, puts a lot of weight on the fact that it is presently uncertain about how that path is going to evolve. I think given what we've learned this week, probably we're looking at a more optimistic scenario now than what we might have thought we were looking at before the Pfizer announcement in particular. All this means is that with interest rates low, that's going to be good for housing. It's going to enable those millennials that David talked about to get back into the housing market. It's going to be good for borrowers, and it'll probably be good for corporations and municipals too. So with that, I'm going to turn the floor over to Patty.
Go ahead. Good afternoon, everyone. Pleasure to be here participating again with USF on a program. I'm going to take a little bit of a different tact. The hoopla regarding the presidential election and what the composition of Congress was going to be kind of put a backseat to ballot initiatives, which are programs or questions put between voters that they can decide. They're called ballot initiatives. They can range from, you know, tax increases or decreases to bond issues and everything in between, including things like reintroduction of wolves in the state of Colorado, the implementation of a minimum wage here in Florida, as well as numerous police policy and procedure initiatives. Initiatives can get on a ballot through grassroots efforts or through requirements of the state, especially for debt issues. However, that varies across the state, and I highly recommend that you go to Ballotpedia if you're ever interested, because it's a wealth of information, especially if you have questions before your own state has a ballot question. You can really get some good information there. One note about initiatives or voter initiatives is that they can potentially hamstring a state or local government and force them to kind of go through loopholes to replace revenues and or issue additional debt. Now, I think everyone's familiar with one of the most popular initiatives these days is the legalization of marijuana. Five states, additional states approved either recreational or medicinal use of marijuana this year, and so now that brings us up to 35 states that approve medicinal and 15 states plus DC that approve or legalized recreational use of marijuana. And now states like this because it brings another revenue stream to them. Although it's not that much, it's kind of on the edges marginally. But it is another revenue stream. It could also make a little bit of economic development because they have to vertically integrate a new business into their state lines. And it's also really helped to reduce the incarceration rate that can also help municipals governments save money. And while we're talking about quote unquote sin taxes, 4 states approved some form of gambling, as well as increases on cigarette taxes. Now, what I have to say is that the more states that legalize marijuana and more states that legalize gambling, the less input it has over time, because people can cross borders, and there's not as much as Colorado. So, for example, benefited probably the most because they were one of the first to approve it. Also, a big ballot initiative this year, but not as big as usual. $45 billion in bond authorizations went before the voters for them to decide, and most of them were decided. 38 billion out of 45 billion were approved. Most of them were for local school construction. So the thing is, though, that they weren't as much as in prior years, especially prior presidential election years, because the localities aren't investing as much in infrastructure, and it seems like a lot of states and municipalities did not want to burden their citizens while many of them were unemployed. Now I'll go on to taxes. The state of Illinois, the voters there turned down a changeover to a graduated income tax from a flat income tax. Now, the discussion around this tax was highly discussed on both sides of the fence, and the governor promised that the increase would only go to the very wealthy, and that this increase was needed in order to balance the state of Illinois' budget. But the anti-tax groups seem to have prevailed, and the budget was not passed. I mean, the increase in taxes was not passed. Now the state of Illinois has to go back and rejigger its budget. And apparently now with COVID rising, they may not even be having a legislative session. And this is going to put a lot more uncertainty about what's going to happen with the state of Illinois. And I'll talk about them a little further in a minute. In contrast to that, state of Arizona did increase taxes on the wealthy to fund education. And the state of Colorado actually rolled back an income tax rate to a little bit, and they also rolled back some initiatives that had constrained local government's ability to raise property taxes. And in California, they voted against Proposition 15, which also would have allowed municipalities an easier time of raising property taxes. Okay, now we can go to the chart, please. Okay, so just a little bit of an explanation. Here's a chart of municipal credit quality versus corporate credit quality. And if you look at the bluer lines, the green is general government, the light blue is municipal utilities, and the darker blue is some of the institutions that John was talking about. They're competitive enterprises, so they're transportation, airports, higher education, and healthcare. You can see that the ratings for these municipal are lumped up in more of the AA and high single A category. Now the orange graph is the ratings distribution for corporate bonds. You can see that corporate bond ratings are more distributed in a BBB, BB area, and even have a bunch of fallen angels. Across the highest rating, I think people may be familiar with this, is at AAA, and then the lowest rating is D for default. But right in the middle there is BBB minus or Baa3, and that's where the state of Illinois' rating stands right now. Rating agency, that's just above non-investment grade. It's the lowest of investment grade. Non-investment grade is also called junk or high yield. And Illinois is teetering on the edge. If they don't find a way to raise revenues, cut expenses, and find structural balance, then they may likely be the first state to go into non-investment grade. One of the reasons Illinois has its problems is because, in addition to political wrangling, its pension is very, very high, and it's got a very, very high debt load. So. Now, I also need to say that municipalities since 2014 have been getting upgraded. They've been increasing their reserve funds, reducing their debt. They've got a lot more flexibility. They don't want to be in the position they were during the last financial crisis. So they were somewhat well positioned overall to entering into this. Corporations, on the other hand, had been borrowing and borrowing because rates were so low, buying back shares, doing an M&A, but now more recently, they're doing a lot of borrowing to replenish revenues. And a lot of downgrades have happened in the corporate area. Munis are starting to get downgraded. And I think over the next 3 years, as their budgets need to get cut, they will maybe experience more downgrades. And just quickly speaking about stimulus, you know, some people are saying there's not a good argument for stimulus, although, you know, munis are expected to lose over $1 trillion in revenue through 2022. CARES Act money has not been spent yet, and Congress seems somewhat loath to give irresponsible players, maybe like Illinois, some additional funds. It might be important, though, to give municipalities additional stimulus. Municipal employment or state and local employment contributes to 15% of total non-farm employment, and the slow growth in state and local employment after the financial crisis is contributing, many people contributed to the slow recovery that we had then. So they may double think the stimulus. Thank you.
Hi, Jean. I'll take it over from here. Last but not least on the panel, I want to thank Karen and David and Jean for having me as a member and as a participant. I thought about this and thought about the post-election and what the effects were going to be. And I thought about when I was going to give a presentation, kind of a short kind of message was, how would I talk to my students about what's taking place? And there was one individual that came to mind, and there's also a factor that I always talk about, a variable. Well, the Fed chairman came to mind for me, number one, and then interest rates came to mind. So I had a chance to listen to Fed Chairman Powell speak last week at the European Council, and he said some interesting things, and I want to kind of relay them back to the participants today. Powell said the economy as we knew it may be over. Think about that. The economy as we knew it may be over. And I start to think about, well, where's he going with this, right? In the post-pandemic economy, it's going to be a different way. It's going to be different fundamentally. And he mentioned some points. He says the crisis is accelerating a lot of pre-existing technological changes. And it takes me back to my years on Wall Street when I came up as a technology analyst and I saw when the internet came into play and how it transformed workers and businesses and how we live and how we work and how we make contributions, okay? So these changes are now coming, I think, back into play. This is not the internet, but post-COVID, what we're gonna have is we're gonna have technological changes that are gonna affect everyone. Today, I do classes synchronously online. If we didn't have that opportunity, I would probably not have the chance to teach my students in a classroom, given what's taking place. But Chairman Powell said, technological changes raises productivity over long periods of time, and they tend to be broadly shared, okay, across all groups. But in the short term, this may not be the case. You may see dislocations, and that's what is taking place now. And these dislocations may have different effects on different groups of people. He also said the economy is recovering, but not to the previous one. It's recovering to one that's levered toward what? Technology. That will make it difficult for many workers who will be displaced. Okay, these workers will be displaced in the service sector. Disproportionately, this will affect relatively low-paid, front-end facing public workers in the service sector that is skewed towards lower-paid minorities and women. So think about some of those participants in the market, minorities and women in different communities, and how will that have an effect on them going forward? And how do states adjust, right? We talk about municipals in trying to find accommodations for either work or employment for some of those people. And then he talked about the new economy will have more telework and automation. And even after the economy gets back to normal with a lower unemployment rate in the post-pandemic recovery, there's going to be a large group of workers that will need to have support, and it will be different. So think about that going forward, because Bob did a great job of talking about interest rates. And we've been in this deflationary environment for quite a while. And we've seen where CPI is, right, Consumer Price Index, and how we haven't seen inflation rise to the 2% level that the Fed's looking for, okay? And that's having a dramatic effect. One thing that I came across, and I'll leave you with this, and it was a great piece written, I read the Hoisington Investment newsletter, and it's a quarterly letter. And they talk about this debt trap. And I want to source them on this piece because it's very, very interesting. The concept of the debt trap is consistent with scholarly research from the 19th century to the present, which indicates that high debt levels undermine economic growth. Now think about the debt levels and where we are today. This causality is supported by the law of diminishing marginal returns derived from universal applicable production function. Historical declines in economic growth rates have coincided with record levels of public and private debt. Total public and private debt jumped from 167.2% of GDP in 1980 to 364% in 2019, with an estimated record of 405% at the end of this year. And we have not done another stimulus package yet. Gross government debt as a percent of GDP accelerated from 32.6% in 1980 to 106.9% in 2019 to an estimated 127% by the end of this year. As proof of this connection, each additional dollar of debt in 1980 generated a rise in GDP of 64 cents. Think about that, a rise in GDP of 60 cents. Up from 54 cents in 1940. The 1980s was the last decade for the productivity debt to rise, the 1980s. Since then, the ratio has dropped from 42 cents in 1989 to 27 cents in 2019. And I thought that was a very, very interesting piece of where we are today and where we're going into the future. I will leave you with this. I think next year is probably going to be a better year, but it's going to be a different year. And we're going to have different companies emerging like we see today. Today we're on Teams and we're able to reach out to many participants using technology. There's Zoom video. We have exercises using Peloton exercise bikes. So our world is changing. The United States is changing, and the way we live and the way we work is changing. And I think that's going to have a dramatic effect. I kind of agree with Bob. I don't think you're going to see interest rates rise for the time being and probably for a long time. One thing that Bob did not mention, which I find interesting, is low rates are good for many, but for my grandparents, they're not very good who live on fixed income and they're making investments when you're getting yields on the 10-year of less than 1%. So I'll leave you with that. But as we look into the future and as we look into next year, it's going to be very, very interesting with a new administration to see how we tackle green, number one, two, how we tackle the deficit that we continue to build upon, and then how we get Americans back to work and how we figure out how we educate these displaced workers to move them into higher paying productive jobs. Thanks, and I'll turn this back to Gene.
I want to thank our panelists for this overview of the bond markets and credits with a particular focus on interest rates, the Fed, and the Congress. We already have some interesting questions in the Q&A, so we'll leave this at the end of the presentations. Our next panel will discuss domestic and international equity markets post-election. And it's my pleasure to introduce the panelists. Matt McAleer, Executive Vice President and Director of Equity Strategies at Cumberland Advisors. Bill Witherell, PhD, Chief Global Economist and Portfolio Manager at Cumberland Advisors. And Leo Chen, PhD, Portfolio Manager and Quantitative Strategist at Cumberland Advisors. Gentlemen, the floor is yours.
Thank you. This is Matt McAleer. Pleasure to be with you today. And it's quite a challenge I have to discuss in the next 5 minutes, because if you know me, I can't discuss the equity markets in an hour or two. So when I was told I'd have 5 or 6 minutes to chat about the equity markets, I just chuckled. So here's what I'm going to do. We're going to share 3 slides. We're going to talk about what's affecting the markets today, where the battle of supply and demand is amongst indexes, amongst sectors, amongst industries, how we might position ourselves going forward, and what we have to pay attention to in terms of changes in the market. So if we pop up slide number 1. What we're looking at here, and I wanted to keep everything short term today. We're looking at a 12-month equity class performance. What we're looking at is different equity classes, large, mid, small, growth, value, versus the S&P. When you look over on the right-hand side, that's not net return we're looking at. That's the return of the specific class versus the S&P. So 12 months, what are we looking at? We're looking at 16% outperformance of large cap growth stocks against the S&P. If you weren't in technology, you're wondering where this great performance is. Because as we look down, you see every other class is trailing the S&P over the last 12 months. IWM's the Russell 2000, 7% behind. Just glance down to the bottom, VYM, which represents high dividend yield equity stocks. When I was coming up 25 years ago in the equity business, it was drilled into my head, the safest place to be were in dividend paying value names. That all changed in 2008. We can track everything you're looking at today back to 2008. When the market fell apart in 2008, the previous widow and orphan names, the banks, the insurance companies, all fell apart, all had to get bailed out by the government. That's changed thinking in terms of what is safe in the equity market. Look at the money that's flowed into these bulletproof balance sheets like Apple, Microsoft. Take it even a step further and look to some of the internet names. That's what's considered safe today. So we come through this pandemic, and we used to talk about it weekly on our trading calls. Money flows to where the trader or investor is confident that that money won't disappear. So that's what we've seen over the last 12 months, starting to see a little change. And if we slide to slide number 2, I wanted to take a look at the last 3 months. And these are running numbers. These are just through Friday. So these are up to date. What do you notice here? The large cap growth still trading just fine over the last quarter, but some real performance improvement out of the other equity asset classes. Why? Why are we seeing this improvement? Well, number one, you can run to a scenario where you get a little bit of a regression to a mean. I mean, we are at record disparity between large cap growth and small cap value over the last 5 years. 50% disparity. So what we're starting to see is money rotate into these names that have not performed whatsoever. Part of that is people feeling more confident about the market and the economy going forward. Some of that is progress on drugs. Some of that is the fact that GDP, while our economy, you saw the numbers on the charts earlier, took a heck of a smack back in Q1, Q2, it's come back very nicely. As a matter of fact, I remember very few economists or market watchers thinking we'd be anywhere close to where we are today in our domestic economy back in March and April. So we've really snapped back nicely. This has had traders and investors start to take some risk in areas that they had shunned earlier. Names in the financials, industrials, basic materials. If we go to the third slide, and it is my final slide, I wanted to take a look at the past 4 weeks, just the past month. Now you can really start to see what's been taking over in the near term. Look at the bottom. What's the weakest performing equity asset class over the last 4 weeks? Large cap growth. Money rotating out of large cap growth into some of those previously underperforming sectors. I wanted to bring this up because it's the biggest question we look at week to week now in how we position our equity portfolios. Does this rotation have legs? Is this a rotation like we saw in 2010, out of value into growth? Don't forget, coming out of 08 and 09, value got knocked down so hard that back end of 2009 into 2010 were good value markets. A lot of traders clung to those value markets and never came completely away from them into growth. What we want to make sure as portfolio managers and traders and investors is we're looking at this analysis on what's working, large versus mid versus small, growth versus value, because that is how we have to position ourselves to make money going forward. Last week, last month, last quarter, last year don't matter. It's how we're positioned today to make money going forward. So we're structured in a way that diversification has come back into vogue over these last 4, 8, 12 weeks. There's money to be made in the industrials, the basic materials. The question is, and I don't have the answer for it, and by the way, neither do you or anybody on this panel. The question is this rotation going to be longer lived? Can we make money longer term, or will the money return to where it's been treated best? Large cap growth, bulletproof balance sheets, 20% earnings growth. Be very, very interesting to watch. And, you know, I say it'll be very interesting. The equity markets and the bond markets, but the equity markets, which I'm partial to, are interesting 365 days a year, both domestically and internationally. And international, for the last 6, 7, 8 months, for the first time in ages, has gotten a nice little bid to it. It's been a horrible underperformer, and we're going to jump to Bill Witherall. Keep in mind when you're listening to Bill that the emerging markets, the broadest name that people follow is EEM. It's the largest ETF. Only recently got back to its 2005 levels. Think that through a little bit when we talk about regression to a mean or reversion to a mean. If there's opportunity overseas to complement some of your domestic holdings. That's it for me. Bill Witherall, take it away.
Well, thanks, Matt. And good afternoon, everybody. Yes, I want to take our discussion over to the global markets, equity markets, the international scene. They're closely related to what's happening in the U.S., but these markets offer another opportunity for diversification of your investments. Can I have the first slide, please? I wanted to take a quick look at the economic outlook, the global economic outlook, and particularly for outside the United States. David Kotak's chart showed dramatically what happened in the U.S. this year in terms of how economic growth took a steep decline, and then in the end of the first quarter and in the second quarter, and then bounced back, but not all the way back in the third quarter. And that happened really around the world, and for the same reason of what the pandemic and its economic impact, the global growth. What I'm showing here are the projections of the OECD that they made in October. I'm pretty sure if they did them again today, they'd be a little less positive. They would downgrade somewhat the current year numbers because the fourth quarter is looking weaker than everybody thought in October when these numbers were produced. but they're broadly right, I think. The world economy is going to see a decline, register a decline this year of something like 4.5% overall. United States will also be negative for the year, not quite as much. The Euro area, Europe, much greater negative number. In fact, if you look down this table in the second column, the only one that sees positive growth overall for the year is China. China was hit by the virus first, and it managed to have a pretty successful battle against the virus, and so it's recovered. Its recovery started before the rest of the world, and it's going pretty strong now. India was hit, but much less progress in combating the disease. Same is true with Brazil. And a number of the emerging markets have had a difficult time, even more than us, with the virus. The numbers for 21 are positive and look pretty good. It's in part because of recovering from the decline, and most are. The recovery in Europe is the one that concerns us most, because they're really having a bad time right now with the virus, as is the United States. Asia has done better, and as I mentioned, China. I could also mention even more success in countries like South Korea, Taiwan, New Zealand. They've done a better job in dealing with the virus, and next year it looks like a good year for them. Can I go to the next slide? This takes a look at equity market performance, global economic equity market performance. My numbers in the final column are year to date, and I should mention that that's different from Matt. Matt showed some 12-month numbers for the U.S., and these are year to date. And so I don't have the U.S. separate on here, but U.S. Year to date, SPY is up about, I think, around 11.5%. So in the rest of the world overall, you get a positive equity market increase of around 8%. That may be surprising when you see what happened to the economic numbers, but equity markets are looking, investors in equity markets are looking ahead. So what you're seeing is some of the optimism about what will happen in 2021, particularly with the virus vaccines coming on stream. If you look at the second line, if you remove the United States from the global numbers, the equity markets are up year to date only about 2%. And I won't go through all the numbers, but the third line shows the advanced economies aside from the United States, and there we're barely positive for the year, and that's in large part due to Europe, which is having really a problem dealing with the virus, and that's particularly it's been particularly true in France and the United Kingdom, in Italy and Spain, and right now it's also hitting Eastern Europe very, very hard. Japan, the Japanese numbers have been pretty good. It's a economy that's growing, recovering slowly. It never grows particularly fast because of demographic factors, but its equity markets are looking quite healthy. And this year, investors there so far are up around over 7%. Emerging markets are up overall or about 7%. And a large part of that is China. The Chinese economy is doing very well. It's recovered earlier. It's second largest in the world. It's very heavily oriented towards internet markets, the high tech. I think it has more electric cars than the U.S. has, and its equity markets are up 24% on, and that gain, a lot of it came earlier in the year, but it's still holding in there. South Korea, again, in part because of its success with dealing with the virus, is doing very well. Brazil had dismal success in dealing with the virus. It was very, very poorly managed. It's down over 30% this year. It's picking up recently, but it's coming up from the depths. Not on this table, I would mention also Taiwan is doing very well. And we like Taiwan, South Korea, and China in our international portfolios. So we're looking forward to a better year next year. And we'll have to, it's all very heavily depends on getting the virus, the epidemic under control, particularly through the introduction and widespread dissemination of vaccine. And the recent news has certainly been promising in that respect. I'll pass the floor on now to colleague Leo Chen.
All right, good afternoon. I'm Leo Chen. I'm the portfolio manager and quantitative strategist at Cumberland. You may also know me as Dr. Chen, as I'm the director of Student Managed Investment Fund at USF Tampa. I'm going to discuss the post-election markets from a quantitative perspective today. Next slide, please. So in my opinion, markets will move ever faster due to the technological transformation. This is the equity market and financial crisis, and also in COVID for comparison. As you can see, what took the market 5.5 years only took 6 months this year. So looking at the right-hand side, back in October, on October 9, 2007, market made all-time high in the equity market. And then it bottomed on March 6, 2009. And then it wasn't until March 28, 2013 that the market made another all-time high. But this year, if you look at the left-hand side, it's striking semblance. In 2020, on February 19th, market made all-time high, and then a month later, it bottomed out on March 23rd, losing 35%. But it was August 21st, about 5 months later, that the market made another all-time high. It's just a fast velocity of change in the market nowadays. And if you go to the next slide, please. So one of the measures, for example, daily volume, is highly correlated with market price and market movement. The daily volume, as you can see, rose fast into the financial crisis, but then regulations and industry reconciliations tapered the volume. However, in 2020, especially in the first quarter, the volume picked up again. It just shows the velocity with the correlation between velocity and the market change. And about 60 to 70% of the daily volume nowadays is actually done by computer trading or the quant programs. And my estimate is that it will rise to about 80% in 5 years or by the end of 2025. So that's just amazing how we have shifted from manual trading to computer trading. And if you go to the next slide, please. So a typical measure of speed in the market is actually market volatility, something we looked at closely at Cumberland. This is the volatility index, VIX. So VIX uses options to price the next 30-day volatility in the equity market. And it uses both call and put options, but they only use the out-of-money options. It's a perfect example of quant finance, but it's not a perfect product. We all remember the infamous Credit Suisse ETN XIV back in 2018. The ETN dropped 93% on one day and lost about $1.9 billion. So this is the new world we live in. Technology will drive market speed, which is a challenge to active money managers. But risk management should be built into portfolios. As you can see, the VIX average is below 20, but temporary VIX spikes should be expected more often because of the trading volume and the computer trading rise in the market. And if you go to the next slide, please. So, well, it's not updated. It's okay. Maybe you can go back to the previous slide. I'll just verbally talk about it. So there was a different slide I prepared, but just for the aforementioned reasons in terms of volatility and risk in the market, I believe hedge fund industry will see continuous growth past 2020. As you know, hedge funds are the main players in the quant world. And the hedge fund industry performance has been lackluster, but they mainly attract savvy investors with understanding and risk management. For example, by hedging, Universa returned 3,612% in March 2020, this year. And Saba, another hedge fund, returned 72% in Q1 2020. And the commodity fund managed by Pierre Andurand returned 63.7% in just March alone this year. So this is what typically hedge funds do. They tend to hedge and mitigate the risk. And for that, they have a large clientele, especially among the high net worth institutional investors. However, please note that the Barclays Hedge Fund Index is still only up 1.6% year to date in 2020 versus the S&P's total return, which is 13.5%. So underperformance in hedge fund will probably continue, but fortunately, hedge funds only need to outperform the expectations rather than their benchmark in the future, which is why right now benchmark agnostic investing is getting popular among quant funds and especially hedge funds. And if you could go to the last slide I have here. Oh, there you go. There was the hedge fund. All right, maybe, you can just take a quick look here. It just shows the growth in hedge fund industry globally from 2000 to all the way to 2019. Well, I'm curious to see the 2020 number, but could you go to the next slide, please? Oh, okay, so the next slide isn't updated there. You can go to the next one based on the hedge fund part. That's fine, thank you. So what I want to talk about, the last slide was that, as you know, quantitative finance analyzes market behaviors, and the Cumberland Advisors focuses on behavior finance and builds our strategy on risk management with a concentration on capital preservation. So we have accumulated some successful track record with both absolute and risk-adjusted returns, especially this year. COVID sell-off and recovery have provided our quant model enormously rich data to improve, and we have taken advantage of the market volatility. I had a picture of people or investors showing their emotions during the investing, but what I like to remind everyone is that please keep your emotions aside, as numbers don't lie. This is the world we live in the future. Market will move fast, and more likely than not, it will move against you at some point. So we have to keep our emotions in control. And that's all. Thank you.
I want to thank our panelists, and we're going to move to answering the questions. We have already a couple of interesting questions in the Q&A section. The first question, this will go to Chairman David Kortok. The question reads, how does Joe Biden view of the U.S. relationship with China in a financial aspect? Chairman?
Do you hear me?
Yes, go ahead, Chairman.
Yeah, so we see China expanding its role for the first time in a more aggressive international structure. And we expect China over time to continue to do so. Chinese companies have made decisions to ignore the New York financial markets and to use financing on their own in Shanghai and Hong Kong. So a development is taking place between the first largest economy and largest financial market in the world, the United States, and the second largest economy, which is now just expanding into financial markets in a global way. And we expect that to continue. So we have a new player. The player's just begun on the world stage. Our point today is one has to be aware of it. We think it's a mistake to think centrically only about the United States. And that's why you heard Bill talk about international exposure, and you heard Matt talk about international exposure. And even though we are actively involved in US dollar denominated bond management that Patty and John were talking about, we have to keep one eye on the rest of the world, because we're in a global system, in a global financial system. Whether we like it or not, we are interrelated with all of them.
Thank you, Chairman. That relates to also another question in the Q&A section. Will the U.S. adopt the negative interest rate to the pandemic? This question goes to Bob.
Thank you for that. I think that that's not going to happen. There's a lot of controversy, a lot of evidence that the negative interest rates really haven't helped. There's concern that if rates go too negative, it actually can be counterproductive. There's no constituency among the Fed staff or the governors or the Reserve Bank presidents that I've come across at this point in time that would lead one to think that they would ever embark upon a negative interest rate path.
Thank you, Bob. Another question here. This question goes to John. What's your opinion, short-term, long-term, for municipal bonds, closed-end funds?
Question is, what's our outlook on closed-end funds, municipal closed-end funds? They certainly have a role for people out there. They generally sell at a discount to their net asset value. That's just a function of being something that trades on an exchange, and most closed-end bond funds, a lot of them do trade at a slight NAV. Many of them carry leverage. Not everybody's always aware of that, which is when you see the fallout like you did in March of this year. you saw some dramatic eradication of value in closed-end funds. That actually makes them buys, not sells, but unfortunately it's the selling which produces such dramatic erosion of prices. Our viewpoint is when yields become extended and prices become really knocked down quite a bit, we will venture into them. They're generally well managed. They're generally will diversify. The problem is like anything else, you can't always measure what's in a closed-end fund, which is why we always preach the value of owning individual bonds when you have a sufficiently large portfolio. I would expect that as you get a Biden administration in, that the outlook for an eventual rise in, tax rates will probably start to help all municipal asset classes, and closed ends wouldn't be any different. And I would add also that, and I didn't show this chart, but we saw going into the election almost no municipal bond issuance at all. And that's because issuers were really taking the approach, we're going to wait until the election before we issue bonds, because they all remember how interest rates gyrate. So in other words, they issued them up front. They didn't want to wait till you got to an election, because I remember 4 years ago when you saw a rise in interest rates. So we saw tremendous issuance, saw no issuance since the election, or a couple of weeks or a week later. We're starting to see issuance now. I would expect closed ends to be a very good vehicle for people as you go into the end of the year when there's a big rollover period.
Thank you, and thank you for that answer. And this goes to another question which is related, and this goes to Eddie Sanchez. For individual over the next 5 years, would you recommend saving money or putting it for investments?
Given where interest rates are today, I think that's a great question. I would recommend, talking to Matt and having him find you some opportunities and some good dividend stocks. It's pretty interesting how we've come out of, a vaccine from Pfizer and then Moderna, right? And how the banks have rallied. And you've got some legitimate value there, and you've got some interesting dividend-paying stocks that are trading, especially in the banks, at depressed levels. So if Bob is right, and I kind of agree with him, given globalization, it's going to be very hard to get rates back up to 2 to 3%. So if you can find dividend-paying stocks that maybe give you a dividend yield somewhere between 3 and 5, I think going forward would probably be the best place to be, in my opinion, given that I think things do get better. And I think one thing that this past president wasn't able to get done, but maybe Joe can get done, is some sort of infrastructure package, because then I think you will see a different economy. So I'm a believer in the stock market going forward, but I think I agree with Matt. You're going to see some of the money come out of these larger cap names. Remember, I did a chart, but I just to leave you with this. And if you look at the valuations of Apple, the FANG stocks, and I added Microsoft, we were looking at about $7 trillion in market value. Think about that for a second here. You could buy a lot of JP Morgans with the market caps of some of those technology companies. So there's money to come out, and I think you may find some opportunities in those sectors.
Yes, and that is a question about actually about Apple and Amazon. So the question reads: currently, 2 companies, Apple and Amazon, account for 3% of U.S. gross national product. Can they amount to 25% or greater in a few years? I don't think so. Please explain how this valuation structure works out over time, Matt.
Yeah, that's not unknown in the market. And in terms of the FANGs plus M, if you want to throw Microsoft in there, they've outstripped the negativity around them for the last 4 or 5 years. There's been an awful lot written and studied in terms of that strength. Do I think they can continue the same kind of strength? Well, you've got all sorts of scenarios that tell you they can't. Number one, do we get a government clampdown in the way of further discussion on antitrust movement? Be interesting to see. That would certainly slow down, you would think, some of the flow into those names. But when you look at the innovation going on inside of these names, that's what's been missed by the FANG knockers. The innovation is incredible, and what it's allowed this economy to do, and we talked a little bit about productivity earlier. The productivity you're seeing in an average company through the use of the technology provided by these companies is driving incredible efficiency. So where are they valued at 5 years from now? That's anyone's guess. You know, strong opinions loosely held is the way to take a look at those type names. You can have an opinion that they aren't going to continue to trade well, but if you marry that opinion, there's a lot of people that have been carried out in a box.
Thank you. I'm gonna take a last question here, which is interesting for all of you. So the question reads: so you are collectively saying that the Trump claim is having the best economy ever, and the predicted economic crash with the blue wave is not likely to happen given the mixed election results?
It's John. I'll take one stab at that. I think what we're saying is that it's really twofold. You have to almost look at it from the bond side and the stock side. But if you look at the fact that you're most likely going to have a divided government, you're going to have a government in which case is probably more cooperation for no other reason than President-elect Biden's history, right? He's in the Senate so long and knows a lot of the senators that are in the current Senate, even going back to his own time there. What we're saying is that it's harder without the blue wave to pass legislation that's not universally kind of endorsed by everybody. And that's why I said that's a pretty good environment for municipal bonds. You probably might get a bump up in the tax rate, but not much else. Somebody mentioned that you probably have a good chance to have an infrastructure bill. We think that's good. And I would suggest that different infrastructure looks different through the prism of the virus. So you might have an infrastructure program that's helping to rebuild some of the bridges and roads, but not necessarily that we need more runways on airports right now. So there's a distinction in there. So we're right now we're constructive on that part. Matt might want to take a shot at the equity side.
All right.
Okay, this is Matt. Just quickly, you know, one of the keys to a firm, not to do an advertisement here, but I don't think Cumberland's collectively agreeing person to person on anything within the markets, and that's what makes the markets so thrilling. Differences of opinions, which the firm has, and you make your bets, you make your allocations, and the market will dictate how you weight those, how you have to change your mind, how flexible you become. But I think the term predicted economic crash with the blue wave, be careful about predictions, especially with your own money.
Is there a chance for 1 minute additional answer to that question, Dr. Kabongo?
Sure, Chairman. Please go ahead.
So not to look at stocks or bonds, but the question was posed in the US and the economic outlook, and would it be a catastrophe? That's what I remember. And the one thing that strikes me that is not part of the post-election discussion so far is a reversal of policies which will open up the US to people who want to come here and work here, which will release 800,000 or 900,000 DACA citizens who want to be here, work here, and flourish. And as others on the call have said, we have had a massive change in technology and productivity. What makes an economy do better? More productivity and a growing working population that wants to work. And for the last several years, the policy of isolationism, restrictions, protectionism has dampened those things. And this election outcome suggests that's going to reverse. So I think the US economy, and this is an opinion, who knows what it'll be like, may have a growth spurt coming out of the recession and the shock of COVID. And part of that growth will be this gain in productivity. We're all doing it on this call. And the addition of several million younger people who want to be in America and work and flourish in America. And that would be a very positive economic outlook, and it would also be good for stocks and bonds. I hope that's helpful.
Thank you, Chairman. We would like to continue this discussion, but our time is limited. As you can see, as they say, time flies when you are having good discussion, right? So I'd like to thank our panelists for their time and for sharing their wisdom, expertise, and knowledge with us today. Many thanks to Dr. Holbrook, Regional Chancellor of the University of South Florida, Sarasota-Manatee campus, for her time. Thanks to Cumberland Advisors for the original idea to organize this virtual event. Thank you to the team from the University of South Florida, Sarasota-Manatee campus for the hard work behind the scenes. And we appreciate the advices from the Global Interdependence Center, or GIC, that helped organize this event. Finally, I would like to thank you, the audience, the participants, for your time and interest in our virtual event today. So remember, the event has been recorded, so we will be emailing you a link to the event. And for the question that we didn't have a time to answer, we will try to get them to the panelists and forward the answers to you. We hope this was helpful. Let us know your thoughts and comments. And finally, I'd like to say, be well, stay safe and healthy. Until next time, bye-bye, from the University of South Florida, Sarasota-Manatee campus. Thank you.